Okay, we're going to be getting a bunch of new accounts in this next chapter. So I want to make sure that we go over each of the accounts, and then I'm going to go over how they apply to transactions. Okay, so previously we've been working on service businesses, meaning that we provided a service like rentals, guide services, things like that, car wash services, and then we were paid for it. Well, what if we're running a merchandising business, meaning we sell items in return for profit? Okay, so it's a little bit different when recording transactions. Okay, so the first account we're going to add, which is called merchandise inventory. This is going to be an asset account, and it's going to be the items we will be using for resale. So we'll still have our store equipment, office equipment, those kind of things we need in our store to help us sell, but the items we are purchasing to resell to our clients or our patrons, if you will, is going to go in merchandise inventory. And since it's an asset, it's going to increase on a debit and decrease on a credit. Okay. Next, we have our sales account. So anytime we sell the merchandise, okay. So if I'm Target and I sell some toilet paper, okay, it's going to be recorded in sales. Okay, that's going to be our revenue account. It's going to increase on a credit and decrease on a debit. Now, just like every business, we have sales tax. So we need to have an account to record it in, because that is not revenue. It's a bill we're going to have to pay. Because eventually, all that tax we collect on sales, we don't get to keep that. We have to pay it to the government. So we're going to record that in a liability account called sales tax payable that eventually we're going to pay. So it's going to be an increase on credit and decrease on debit. Okay. Now, just like any business that sells items, we have people that return things just because they realize they didn't need it, they didn't want it, something's broken, it didn't work. So we have to have an account to record that in. So we have sales, return, and allowance. This is considered a contra account, and contra stands for contradiction, meaning it's the opposite of sales, because you're not going to debit sales because it's a revenue account. So all we want is the money coming in. So we need to do a contra account called sales, return, allowance. It increases on a debit, increases on and decreases on a credit, so the opposite of what our sales account is. Next. Okay, so we start out with accounts receivable at the very beginning, one accounts receivable. Then we switched, we had accounts receivable for each client. So now we're switching again, and we're using what's called a subsidiary ledger. Okay, so essentially we're going to have accounts receivable, which is a controlling account, meaning that its total will be equal to all of the items in the subsidiary ledger. So the subsidiary ledger has each individual client, individual that owes us money listed separately. Okay? So again, you have your subsidiary ledger, which is the client's different accounts that we keep the balance for each client in. And if you add it up, it should be equal to the amount in accounts receivable. And we will have, every time we record a transaction, it'll be recorded twice. Once in the accounts receivable and once in the subsidiary ledger. It'll make sense when we get there, okay?